In this video, traders, we're going to look at 7 mistakes to avoid with dollar cost averaging. Stay tuned. Hey traders and investors, a very warm welcome to you. Okay, so dollar cost averaging, as we know, is if you don't know, by the way, go and check out another video I've done on dollar cost averaging. It's basically investing a specific amount every single month into stocks, a broad selection of stocks, an ETF, a fund, stock market basically. So instead of trying to time the market, you're saying, hey, you know what, I can't time the market. I don't want to invest all my money at once, or I'm using it as part of a salary, whatever it may be. The point is you're trading very, very methodically. The system is a set amount each month, but there are some mistakes that people tend to make with dollar cost averaging. So 7 mistakes, let's go. The first one is not starting early enough. What does that mean? So the sooner you can start investing some capital, a small chunk every month into stocks, into bonds, into commodities, whatever, and obviously seeking financial advice for your risk tolerance. But the earlier you start, the more compounded growth you can get. It sounds obvious, should I say, but people forget it. People think, oh, I've only got a small amount, I'm not making so much when I'm in my early years. Everything that you put into it starts to accumulate and add up. And if you get the right time, if you're not timing the market per se, but if you happen to be in a good cycle and you're in a good growth, that's going to turn into a significant amount in a very short time, especially if you're adding to it all the time. So start as early as you can with dollar cost averaging for the best success. All right, number 2. Not investing consistently. The part of this system that works, and the reason this system works in terms of spreading risk, in terms of eliminating horrible big stupid drawdowns, it didn't eliminate them completely, but what I mean is if you put a big lump of sum in, it happened to be at the top of the market halved, with your dollar cost averaging, you're not going to get that much of a brutal move. But not investing consistently, once you decided to do it, you need to be doing it consistently, otherwise it just completely ruins it. If you try and time the market, or if you miss some inputs, sometimes they could be the thing. Someone stops doing it for a year, that can be the difference between kind of a massive gain or a massive loss. So the important thing is that you do it with consistency and having an amount that you can afford to put in each month into the assets that you've already decided you're going to put into. Number 3, forgetting to rebalance. So what this means is, let's say, for example, you have gone into 50% stocks, 50% bonds, wherever it may be. Stock market has a big rally. Your assets are now worth more. Of course, the balance of your portfolio has changed. You're now much more heavyweight on stocks, and perhaps you need to be consulting with an advisor, or you need to have a look for yourself and see how you want to be reweighted. So just because they've had a good run, it doesn't necessarily mean you want to stay overweight with stocks. You might want to take some of the profits out and rebalance a little bit. So put some in commodities, some in bonds, whatever it may be. But forgetting to rebalance the portfolio to what you want, or the risk tolerance you want, or the baskets and assets you want, is a big thing that some people forget to do. All right, number 4, abandoning the strategy at the worst time. This is pretty commonplace. If you're going to stick to it, the benefit of sticking to this is that when the market is in a bear market, when things are getting hammered, you are still consistently putting money in. It can seem like it's just throwing money after bag, because you put money in, next month it's down, you put money in, next month it's down. But the important point is that you're not trying to time the bottom of that market. You're adding and adding and adding, and because you're doing it every month, you're going to get the cheaper share cheap, but then you're going to buy again as it comes back up. And the point is, if the market turns, you've spread your risk all across that turning point. You haven't tried to stab it and time it. You've spread it all across that, and hopefully when it now rotates back into a bull market, however long that takes, you've now got a big chunk of stock, a big chunk of assets at that low price, spread across that, an average price that allows you to get the growth from the next coming up bull market. So, and it's easy to abandon it because you think, are you looking at your statement thinking, oh, it's not doing so well, it's not doing very good, I'm losing money at it. But if you've got a good split, you've got a good kind of lots of different asset classes, different stocks, and you've got a broad, a selection of investments that are in line with your thesis or your tolerance, then, you've got to stick to it. All right, number 5. Being too hands-off. This is a case of if you've picked specific stocks, you've decided to allocate capital to specific stocks, you still need to have a kind of point where you've got a stop loss. You don't want to, obviously this depends on what you're trading. Okay, and it also depends on what assets you're putting in and your risk tolerance as well. But the point of this is you can't just put it in a stock and put all your money and forget about it. If you've picked a selective stock that you think is a little bit more risky, perhaps, there's a little bit more potential for upside growth, and that doesn't happen, the company starts going down the drain, you need to have a point where you pull your money out and reallocate it. You need to have a plan of action. You can't just still be applying money. I know it's kind of counterintuitive to what I said in the previous one of abandoning the strategy at the worst time. That's more from a broad perspective. Like if you're still allocating capital to assets broadly, it's abandoning that. This is more, look where your assets are going and decide if you've got a point where you want to reallocate it elsewhere because the stop loss has been hit. It's drawn down 50% from the high, 20% from the high, whatever it is. It's not a company that ticks your boxes anymore. You wanted stocks that were high growth, high dividend, whatever. This has now changed to something else. You need to be aware of that and be a little bit more hands-on with how you monitor that kind of thing. All right, number 6, taking too long to invest a lump sum. So you get a lump sum, the whole point of dollar cost averaging is you don't take, let's say you've got 100 grand, you don't suddenly go and stick 100 grand in the market because you're vulnerable to, you're trying to time the market, number one, you're vulnerable to short-term swings. The idea of that is you will split it up into chunks. So the best thing you can do is instead of taking 100 grand and having 1,000, 100 of those over 100 months, the better thing to do is to split it into 10K a month, or even more than that, and have it into a short period of time, because taking too long means you've got the money's not making money for you. Now, of course, if you're in a bear market, you might find that then that's good. But the whole point of dollar cost averaging is you're not trying to time the market. So the quicker you can get that money to work, spread it out over the year, whatever it may be, the quicker it's going to do something for you, and the less likely you are to try and time the whole thing. Get your money, allocate, chunk it out into how many chunks you got. Do it in a short space of time, not too short that you're ruining the whole point of dollar cost averaging, but not too long that it's taking you forever to get into the market. And by that time, you can have multiple cycles back and forth. Okay, number 7. Ignoring trading costs and fees. What you don't want to do is forget how much it costs you to make the trade and make the deal. If it's very expensive and you've got a broker that's charging you a fortune to trade every time, you're eroding your capital just purely from fees, but because you're trading such a small amount each month. So if you have such a small amount that you need to choose a broker that doesn't cost you anything to trade. Many brokers out there now don't charge you to trade, or very, very little to trade, very, very small amount. Have you got any other costs involved in it? Are you trading stocks in another currency? You've got to pay some kind of fee to have that feed. Take stock of how much it's costing you to do this strategy or to execute this strategy, and just keep an eye on those fees, because you don't want to be paying hundreds of dollars a month when you're only putting in $500 or $600 in capital, because it's just eroding the gains and you're never going to get that money back. It's just wasted money. All right, guys, 7 mistakes to avoid with dollar cost averaging. Take care. Bye-bye.